Those 2+% gains on Wall Street and also fading fears the US economy was headed towards a double-dip recession and deflation. The 30-year yield, we watched it rise about 8 basis points. The 10-year yield rose 6 basis points. Stephen Nash is from FIG Securities and joins us in the studio now. Stephen, good to have you on board. Something that's been very obvious the last week is these very exaggerated worries about deflation in the United States. Are the manufacturing numbers out around the globe going to turn things around?
Look, I think it's a medium-term picture where we've been seeing in a lot of the developed economies decreasing core CPIs. I think it's just a theme that can be expected with a lot of excess capacity right now. Will the excess capacity be taken away? Probably, but not immediately. I think towards the end of the year we might see some evidence of that excess capacity going away. But for the time being, I think deflation fears will persist.
Yeah, if not now, even then on the horizon, it was interesting to see a note overnight saying, look, this week we haven't exactly sort of got off to the best of starts. That is to say, you know, the improvement in equities and risk assets, putting, you know, appetite for, you know, fixed income onto the back burner. Yeah. But it doesn't necessarily mean it's not doing anything other than simmering away. The longer a pot simmers, you know, the more danger of something deadly happening. Well, that pot exploding.
Well, the bond market's been concerned about it for a while. It's reflected in those 2-year yields as we've been talking about for a while now. Yeah.
Are you? Yeah. I was going to say, in terms of a level on those 2-year yields, where are you seeing them eventually finding an equilibrium? What sort of price?
Well, I suppose, you know, they are quite expensive right now, but you know, if fears intensify about a double dip, they could gravitate towards the funding level around 25 basis points, but I think that's probably a little bit optimistic right now. However, you know, the market's building in extended periods of no tightenings. However, the equity market's still quite buoyant, so I think one of the markets is wrong. I think possibly both markets are wrong to some extent, but the bond market will probably be more right in the sense there might be correction coming.
Ahead of the curve.
But why? Because equity markets won't subscribe
I think
to that
it's based on the economic outlook, and the economic outlook in terms of the bond market is not that rosy, and the equity market is holding on to a more rosy view, and I think eventually there'll be some correction in that.
And that's going to imply what? Fed intervention, and if it does happen, who will actually be winning arguments around the table? We know there's going to be a meeting next week.
Yeah.
Already, though, we've heard from the St. Louis Fed president saying we need to have more action. We need to avoid a Japanese-style outcome of deflation, so that requires more quantitative easing. But then you've got somebody like Charles Plosser saying the data's not compelling one way or the other. Yeah. Until I see more, it's like Thomas, until I see all the signs, I'm not going to believe, you know, the US economy has been crucified.
Well, I think the Fed will develop emergency plans that eventually will be used if needed. I think at this stage we don't expect that they will be needed, but I imagine there's a lot of behind the doors ruminating and developing the plans right now. I think you know, towards the end of the year I think we'll see more evidence of growth coming through, but between now and then it's going to be a bit difficult for the Fed.
Is it going to be private sector growth or public? Because, I mean, until now, all the signs are it's still very much in the latter camp. Yeah. What will trigger private sector growth?
Well, I think investment in things like technology. There's been a long period now that the firms have cut costs, and now that they need to reinvest in the business, it becomes effectively eventual. Yeah.
Okay.
Can I bring it back home? And can I just flag to viewers as well, we of course flagged here that we'd have Sally Old, but we've got some technical problems, so we won't be joined by Sally today, but we'll grab her next week. We had very muted inflation numbers here recently. Do you think that those inflation numbers are going to be enough to change the tone of what we hear from the RBA today? We pretty much can expect no change, but what about the tone of that statement?
I think the statement will be emphasising the global themes I think we've been emphasising for quite a while, and they are that at the moment it's probably not the right time to go from a neutral bias to a tightening bias. I think for the RBA to go to a tightening bias, it is quite a big move for the bank. They have to have all the ducks lined up and all the...
They're always trying to keep the doors open for any outcome.
Yes, at the moment I think it's fair to say that particularly in terms of the global outlook, it's not clear, and that the volatility with regard to equity prices and other markets don't suggest that a tightening bias is really appropriate right now. We have the housing market, which has cooled somewhat. I think that's pleasing for the bank. Also, the RBA has mentioned that there's been some pleasing moderation in growth in Asia and possible easing in inflation there. So at this stage, I think that generally there's no argument for the RBA to take that extra step.
So it sounds like sort of a moderated pullback from what you're saying. They can live with that comfortably.
Yep.
I mean, to take it to the other extreme, though, sort of to get a dovish statement whereby they would say, hang on, actually, there could be a slowdown. You're saying those CPI figures weren't soft enough for them to really think, hello, the Aussie consumer is really skittish. We should actually deliver a cut.
Look, just before the recent CPI, every economist in town was going for a tightening. Everyone was emphasising the positive.
Yeah.
We've got one number and everyone's going for, well, like it is. I think the underlying trends in the CPI are firm. The CPI is towards the top end of the range. We've got to remember that. I think everyone accepts that. So an easing bias is probably not on the radar.
I mean, if you want to bring it back to the consumer, I mean, I guess it's likely that even within weeks they could see a hike from their own banks in terms of the borrowing costs.
Well, I think that if you're talking about rate rises, I think look to the banks after the election. I think that funding pressures are there, and that it's probably more likely you get a rate rise from the banks rather than from the RBA.
How likely are you saying at this point?
I think it's quite likely. We do get an increase in mortgage rates. The funding pressures are I suppose, relentless. I suppose you could say that there's a lot of competition in the global market for funding. A lot of global banks out there competing with Australian banks. Australian banks obviously have very attractive credit metrics, but the competition's still there, so the cost of funding is quite elevated. Yeah.
And it's interesting how investors will play that, because, of course, if you're not a mortgage holder, the other argument is that, well, to just have your investments in cash, that's a more compelling case. You know, you're going to be getting more on term deposit.
Yeah.
And if you don't buy the glass half full story, well, we see further light volumes on our market because more people are choosing to hedge and put it into the bank.
Well, also, yeah, well, with this elevated level of funding costs, it's putting pressure on the banks to increase the spreads relative to bank bills. So the TD spreads are being firm or going up slightly at this stage. So the spreads are very attractive. Also, there's some very attractive bond rates out there right now. So people may think about extending out there in the bond market.
Before we have to go as well, we've been catching up with you almost weekly about this Dodd-Frank Reform Act. Whether it's a recipe for a return to crisis or not is the debate, but something you're trying to really focus and hone in on is the ratings downgrades. You really think that that's going under the radar a bit? Yeah,
I think that Moody's have made a statement with regard to putting a few of the major banks on negative outlook, and also some of the regional banks, placing them on review for possible downgrade. I think what we've been trying to emphasise is that there is a rating implication from the withdrawal of systemic support for the banks. And we're trying to stimulate some discussion on this, and I think there is a lot of debate about how far the major banks will be downgraded at this stage. It appears as though there could be one notch in it, but if there's two or three, that could be quite serious for the US banking system.
What are they not managing to achieve that, say, an HSBC model in Europe showed it could do overnight? What's the missing link for US banks right now?
Well, I think, you know, the rating uplift that they had prior to the Dodd-Frank Act was substantial, and it's more substantial for the major banks than the regional banks. The problem for the major US banks is that they're getting close towards that BBB rating range, which is really a different business model to what they've been used to. So,
is this because there's sort of an obstinately high loan impairment sort of equation going on? Why are they drifting into that zone?
Well, it occurred some time ago. Actually, earnings are improving quite a bit right now.
Offset by what?
Well, you've had the loan impairments have been reducing, so the general balance sheet is repairing.
Right.
But the problem is now the withdrawal of the systemic support that comes in on top. As the balance sheet improves, they've got to increase that improvement more than that would be compensated for with the withdrawal of systemic support.
Overcompensate, and that's where they're having a problem. Yeah.
At this stage, yeah.
Okay.
Stephen, it's been great to have you in as always and to cover so much ground. Thank you. Carson Scott with me in studio, and of course we promise to catch up with Sally Old from JP Morgan next week when technology allows it. Now.